Hi everyone, Jon Sharp, President of Hardenberg Insurance Group, coming to you again today from the HIG Academy. Today we're going to talk about open reserves and how they affect your mod. A reserve is a dollar amount that's been earmarked to pay a specific claim that's occurred at your firm. For example, if I'm at work and I fall off a ladder and break my leg, when the carrier is notified, they're going to immediately get the details of the accident and determine what the normal treatment plan is. From there, they're going to set up a reserve for the dollar amount that they expect the claim to be. This is called a reserve. But did you know that the reserve will affect your mod? Therefore, if a reserve is set too high, your mod could be artificially inflated and you could be paying too much for your premium. Setting reserves is a claim handling science, so it's much more difficult to dispute this. But there's another way claims reserves can cost you. We've found in many cases there are open reserves when employees are already back to work. Now that makes logical sense. If, for example, again, I broke my leg and I'm still having rehab, but I can work full time. But we also see more often than we'd like when this person or me, again, it's broken their leg, I'm back to work, I no longer have rehab and I'm at 100%. That's a scenario where this open reserve should have already been closed. If the reserve isn't closed, again, your mod is being artificially inflated. Therefore, you're paying more than you should be. Your risk manager needs to be on top of these open reserves to make sure that they're closed in a timely fashion. If, unfortunately, you do see a reserve that should have been closed to maybe 3 years ago and was just missed, there is a way that we can go back and fix that as your risk manager. The first thing we need to do is appeal to the state and prove that the employee's been back to work and that the claim should have been closed. Once the state has approved that closing, then we take that information and go back to the carriers you've worked with in the last 3 years. They then have to endorse the policy to lower the mod factor, which ultimately lowers the premium, and write you a check back. If you're with the same carrier for that 3-year period, you typically just see a credit. But this is an area where your risk manager needs to stay on top of it, and if they haven't, then they need to intervene on your behalf to lower your premium dollars so that you're only paying what you should be paying for your workers' comp. And that's how an open reserve can affect your premium dollars. Again, my name's Jon Sharp from Hardenberg Insurance Group, and if your risk manager is not talking to you about things like open reserves, give us a call. We'd love to discuss it with you. Thanks a lot.